Good afternoon. Thank you so much for joining us this afternoon. Welcome to our fifth webinar, where we are focusing on building the value of your business. Today's session, we will be talking about the first impressions, whereby we're saying optics matter. And you will understand as a business person, as a business owner, why optics matter when it comes to how you handle your business. For those that will be joining us via YouTube, thank you so much for subscribing to our YouTube channel. You are most welcome, and we're also looking forward to sharing with you on our next sessions. We've got 4 more webinars that we will be doing before the end of the year. And if you have actually missed any of our webinars, you are most welcome to visit our YouTube channel, whereby you can get access to the previous sessions. As indicated, today's session, we are talking about first impressions. At MMCP, we strive to build sustainable, scalable, and sellable businesses. We all go into businesses for a purpose, and we don't just do only accounting and tax and those services, but we focus more on how do we assist businesses to make sure that we are building sustainable, scalable, and sellable businesses. My name is Ntabiseng Maidi. I'll be the facilitator for today. I'm your CA, and I also hold an LLB. I'm an international certified builder coach with the Build to Sell Institute from Canada. I think some of you know the book called Build to Sell. What John talks about in the Build to Sell is what we actually strive to achieve, that we have to build businesses that will be sellable. I actively manage 2 companies, MMCP Wealth as well as MMCP Business Advisory Services. I'm a past non-executive director of listed and unlisted companies. I still hold non-directorship positions, and I have participated. I was a fund manager before, and I have advised on quite a few transactions where I was a transaction leader for those, and I've also had CFO positions. I would like to welcome those that joined us late. Thank you so much for joining us this afternoon. You are most welcome. So today we'll be talking on how first impressions can drive the value of your business. Sometimes we don't realize that first impressions have got a lot to do with how potential buyers or how funders perceive your business. And it is important that whenever you've got, you are looking at selling your business, even if you're not looking at selling your business, we always say that when you sell your business, you only get one take to sell your business, meaning that you can't have a rehearsal of the process to sell a business. You sell it today, you call it back, and then you sell it the next day. So you only sell it once. And at that point, that's when you need to know and understand that you are selling your business at the right price. For an example, let's say you want to bring in an equity partner in your business. Your equity partner is going to want to do a valuation of your business. And let's say the valuation of that business will give them a certain percentage of the business. So you must understand the impact that the value of, or the how you run your business, the impact it has on how the valuation is done. So hence we decided to focus on this session, that sometimes we forget to look at some of the small things that potential funders or potential investors would look at when coming into your business. What I like here is, I like this quote by Walt Disney, where he says, "Whatever you do it well the first time." And most of you will agree that you cannot do something, as I indicated earlier on, you cannot do something with the hope that you will redo it at a later stage. You must do it so well that when people deal with you, they will either come back for more service. If they do not, they will refer your business to the next person. So those are the first impressions. We all know that in the retail space, customer satisfaction, or in any business for that matter, is quite important. So first impressions last. I think those who know, that once you perform something to the best of your ability and your customer is satisfied with your service, the probability of them referring your business or coming back is quite high. Next, let's look at, initially you'd say customers will decide how they spend in your business based on the first impressions or what they see. And here we are going to look at what happens with the investors' initial impressions on your valuation, whether the impact is going to be on the equity that you are intending to give up for the growth of your business, or the valuation of your business whenever you decide to sell. So that's what we'll be focusing on today. And one should be cognizant of the fact that investors have limited time to go through your business, and they also have numerous opportunities to consider. I think we know in the VC space, or in the private equity space, whereby you've got someone that's looking to invest. They don't have a full year to look at your transaction. They've got limited time to decide whether we want to go into this business or not. Also, when it comes to funders, they've got SLAs in terms of the period that they need to consider an investment proposal. And when you put in your investment memorandum, that is the only chance that you have for them to look at it, unless if it is a big project whereby they require you to have some conversation. But the first document that you present to either of those partners is going to matter a lot. And when you look at what are the things that the factors that valuers, I'll put on ahead of a valuer, because I also do business valuations. Typically, when you do business valuations, you only go probably for a week, and you want to consider a whole lot of things when you do your due diligence. And your due diligence is going to give one the qualitative aspects of a business, as well as before you can actually get to the numbers. So you don't have a lot of time to do that. And as I walk in as a business valuer, and I would expect that you prepare certain things for us in advance. Let's say we give you a list of our due diligence checklist, and when we come in, we go through documents. Sometimes we don't even discuss with you some of the stuff, the management comments or that. We just dive in and look at the documents and observe certain things. So these are some of the areas that would generally look at. The first one obviously would be the financial performance of the business. Looking at the revenue, profitability, cash flows, and growth trends. So as a valuer, I'll look at that in the business. The next one would be market analysis. Because when we do on market analysis, we usually also benchmark your business to your peers and what the market is doing and where the market is going. So it's important that we look at the trends, your competition, the market size, growth potential, and the positioning of your business within that market. That is taken into consideration as well. Next, it will be the assets and liabilities, whether you have got a tangible or intangible assets, intellectual property, patents, trademarks, and importantly as well, customer relationships. What is the relationship with your customers, and even some of your suppliers, because some of those suppliers might have an impact on your business in its entirety. The next thing that we look at is obviously your earnings and cash flow multiples. This is related to your financial performance. Earlier on, I spoke about the market comparable analysis. Let's take, for an example, you've got a placement agency that you are running. So when we do evaluation, we will look at your business and consider your peers. Let's say your peers is Accenture. Accenture does that, and Dante, and then we've got there's quite a lot of them. But for us to get a proper comparable value, we'll usually go to the stock exchange, or we look at the precedent, which is past transactions that has happened, where there was a sale or where there was a sale or a transfer of shares. We look at that valuation, we compare it to your company. We use that as a proxy. So market comparable analysis is important. We take that into account. And where there are differences, let's say we find that there are differences. One example, one is listed, the other one is not listed. We consider the one that is listed to be marketable, because when it's listed, people can trade on the shares. Unlike a business that is not listed, it's a private entity, so the buying and selling of that company is not frequent. So we will do a discount. We call it a marketability discount. Then when we also look at the size, if you find that the listed entity is much bigger than the private company, we also do some form of an adjustment because of the size of the business. So from the beginning, as a private entity, you're almost 2 or 3 steps behind from a listed entity because you are a private company. So for you to drive your value of your business, there are certain things that you need to have, and which is what we'll discuss later on in the presentation. So the marketability of your business is it's quite crucial. I spoke about the discounting of the earnings and cash flow financial performance. Here we're looking at the discounted cash flows. And here we assume that there's going to be constant cash flows coming into your business. And we know that constant cash flows are driven by constant revenues. So we will touch on the importance of having revenues, predictable revenues, or constant revenues in your business as that impacts your business. The next one is we will look at the risk. How risky is your business? And the risk can be market risk, volatility of the market, competition, regulatory environment, economic conditions, business dependence on one key customer, or business dependence on one key supplier, or business dependent on one key individual. That is what we look at. Where we find that there is an increase in risk, we apply a discount because your business has got much risk. So we have to discount the price of your business. Next, it's going to be your management and team. Your expertise, your capabilities are quite crucial. The skills and the experience is quite important. However, we also look at where there is going to be a change in management. Let's say you have sold your business, where there is going to be a change in management, where there is going to be a change in the dependency of management, that we discount as well, because we say you as a business owner, you were the face of the business. So we are not sure that after acquiring your business, customers are still going to perceive us well or not. So unless if you can demonstrate that the expertise and the capabilities that you have in your business can allow your business to operate without you, a business like that is much more valuable than a business where it's dependent on an owner. Next is we look at intangible assets, whether it's intellectual property, your brand reputation, trademarks, copyrights, and customer relationships. We don't want to go into a business whereby we buy today, the next day all the customers walk out. Because customers, let's take a business in the financial planning space, whereby your customer, you're a financial planner, and once the key individual or the key advisor leaves, the others will follow. Insurance space is also one good example, whereby when an account manager leaves, usually the account will follow that person as well, which makes it very risky. Exit strategy and marketability. Earlier on, I spoke about the marketability of the business. The easier it is for a potential buyer to exit your business, the more valuable your business is. But the contra is also true, that if it's difficult for let's say an investor to come into your business, if they want to leave and they are not in a position to get a buyer, it becomes very difficult. For an example, in 2001, when the BEE landscape started, when BEE companies started, most BEE companies said we are going to be invested for 7 years and we're going out. So there was a lot of private equity transactions that happened. And then that I think the first wave started before then, I think the 1994s, 1995, 1996. And then in 2001, there was a second wave of BEE transactions, whereby the first guys were selling to the next guys. They wanted to cash out. So that as well. So there was a lot of exchange of transactions. And as the years goes by, the transactions started being the transfer or the selling of businesses became much better. Now, when you look at the marketability of a lot of companies, because you also know that not a lot of people still considers BEE to be important. So initially, because it was regulated that you have to be 26% or whatever, so most companies, to fulfill that, they needed to sell. Now they're finding ways to actually fulfill that ownership component. There's not a lot of transactions happening. Market conditions. Where economic conditions impact your business quite often, we tend to put some form of a discount in your business. One good example, interest rate, foreign exchange rates, those things can affect your business. Industry trends and innovation. You cannot be in a business that does not innovate if you are in that kind of a business. So as a valuer, we will look at the potential that your business has based on the innovation that you have. Last week, I was doing a talk at some event, the mining community, and there's this guy who's doing 3D printing for spare parts in the mining industry. That is an innovative business, and the probability of that guy selling at a high multiple is quite high, because anyone who wants to go into that business will say, it means this guy can innovate, there's more customers, so that gives you some competitiveness. Lastly, it's going to be your legal and regulatory factors, especially where you are in an environment that is highly regulated. So all of this. Oh, lastly, we look at synergies as well. Can your business provide synergies with other partners in the industry? So this basically is what a valuer will look at when they come into your business. I suppose as I was talking about this, you were starting to think as to whether any of them is applicable. All of them are applicable to every business, but where would you fall short as a business owner if we were to come in and do evaluation of your business? Someone might argue and say, no, but I don't want to, I'm not going to sell my business. I just want a bank to give me funding. I want to hold on to the shares in my business. So here is also a list of what the funders would look at. They would want to see that you have got a market and you have got a size, you can capture a growing market, and there is demand for your product. So they will assess the market size, the trend, the potential for expansion when they look at your business plan, when you're fundraising. The business model, and the business model will consider a revenue model. I suppose most of you, if you are in the tender space, you will recall that most banks do not fund businesses that depend on tenders, because their revenue is quite erratic. Besides the revenue being erratic, they've got a very bad customer. So they want to understand how the business will monetize its products or the service to achieve sustainable profitability. So your business model is important. Traction and validation. Do you have traction in the market? Can customers easily adopt you into their business? Sales partnerships. How strong are you in the market? Funders want to see that there is evidence that your business has gained some acceptable level in the market. If you say, I'm still going to find that, they would usually say, do you have, hence they'll talk about offtake agreement and that. But once we've got the track record of customers, it's quite easy for them to actually fund you. The product or the service differentiation. I usually talk to especially vendors that would duplicate a product. We know that whenever we go for funding, they would always talk about differentiation, service differentiation. How different are you to your competition? So that, because once you come with a niche market that differentiates you, or a niche product that differentiates you, or a strong value proposition, that makes the investors quite attracted to your business. So you always need to make sure that you have got a very strong value proposition or a unique value proposition for them to look at your business. Competitive landscape. Funders would always look at your competitive advantage, where there is barriers to entry, and how you plan to stay ahead in the market. So this morning, yesterday, I went to a farm in Limpopo. They are producing more than 110 hectares of potatoes for one of the Simba manufacturers. And so this morning, as I was showing some guys what the farmer there in Limpopo is able to do, one question that came up from this guy said, what are the barriers to entry? An industry where it is easy for anyone to come in and buy and enter that market, it's not valuable. But where there are restricted barriers to entry, it means that your business can operate as a niche, or it has got a unique competitive advantage to its peers. So you need to, they consider that. The next thing they'll look at is team and leadership. I've spoken about that in the previous slide as well. Your business plan and strategy, they always ask about our strategies. No one wants to fund a business that doesn't want to grow, or where it doesn't have a potential or a vision of what they want to achieve in future. So that's that. Financial projections and viability is exactly the same as in the previous slide. Scalability and growth potential. You'll understand that we all go into business to run businesses that can grow. Initially, at the beginning of my presentation, I spoke about the scalability and sustainability of a business. Investors are attracted to businesses that has potential to grow and to scale. Because if they grow, it means there's more revenue, there's more cash flow, and it means you can pay your debt. So if you can indicate those, it's easier for them to fund you. Exit strategy. Is there an exit for them? Let's say they've given you a debt instrument, or they've ended up giving you an equity, doing an equity instrument with your business. Is there potential for them to exit, whether it's through an acquisition or an initial public offering or any other means that they can exit your business from. Next, they will also do their risk assessment. Where there is no alignment with funders' goals, they will not fund you. Yeah, so let's take one example. I'll talk about the Simba thing. Simba is the biggest producer of Simba chips in South Africa. And they've got a fund that they've created with a company called Khudisho, where they are supporting small businesses. So you cannot go as a manufacturer of electrical items. You cannot go to Khudisho and want funding from Khudisho. Your goals are not aligned. So, but you can go to an entity that supports businesses that are in the manufacturing space. Khudisho instead will look at companies that are in the agriculture value chain, specifically products that support their value chain. So in that way, there should be some alignment between the funders and your business. Lastly, how are you going to use the fund? They want to know. And once you indicate how you're going to use the fund, they've got a better understanding of business development and how you are going to grow your business. I've spoken about due diligence extensively in the previous slide. So these are the two areas. You've got two institutions that can look at your business, and what they see first in your business is going to matter. If they consider all of this, that are all of the things that I've indicated here, what they see first is going to matter. And just to put them together from a funder's point of view, from an investor's point of view, we've got 6 things that we say, 8 things that we say they can drive the value of your business down or up. I spoke about problem or solution fit. What kind of a solution are you, or what kind of a problem are you trying to sort out? This brings back to your unique value proposition. Because here you are saying, I am Thabiseng Mokone, or we as MMCP, we have noticed that businesses don't grow, or small businesses or startups die in the first 5 years. And we have created a platform that is working on advising businesses on how to grow. So that is our unique value proposition. So we're trying to solve a problem. So in that way, you get more customers. Since we started with this program, our business has actually just grown more than 100% just in 1 year, because we have identified a problem and we are providing a solution to that problem. Had I sold my business last year, it was going to be valued at probably a fraction of what it could be valued at now. But now I can actually command even a much higher multiple, because I have got now a solution for the problem. The next one is competitive advantage, where you have got, you need to indicate, if you've got a competitive advantage to your peers, it's much easier for you to say, no, I'm not going to accept an EBITDA multiple of 4, instead I want 8. But if you don't have, we'll also assist you how you can get your competitive advantage. Traction and milestone. Traction is Obviously, reputation in the market, how the market perceives your business, whether it's branding or that, credibility and professionalism. How is your team? How is your team working, or how does your team project itself? Where is there market opportunity, team strength, financial goals, and exit potential? Those are the 8 specific things that we've got solutions for, should you want to take this forward. So we've identified this first 8, and we're saying we can delve in for the first one and give you the how you can improve that. And I'll come to that in the next few slides. Let's just talk about quite a few things that we think are important. Problem or solution fit. Here we're saying you have to know exactly the program and how your solution addresses it. It's that should come out whenever you do your pitches. When you talk to potential clients, you need to put that clear, that this is what I'm doing. And the strong problem solution fit, and that aligns to investor interest. Any investor who sees that you've got a very strong problem solution fit will definitely back you up, because they know that you are going to end up having a niche market. Next is the market opportunity. You must demonstrate a growing market opportunity or the potential size of the market. I'll go back to the potatoes. This client of mine only supplies 2 areas, supplies Simba and supplies the Mozambique market with potatoes. That's why he's operating. He's not even interested in anything else, only those 2, because he knows that those are the 2 growing markets. And next, with a sizable and growing market, he knows that the export market is a growing market, hence he is focusing on that. Competitive advantage, I spoke about that. What sets you apart? Do you have patents, IP, business models that can actually put you apart? If you've got a product that is different, you can actually sell your business at a much higher price. I spoke about professionalism and credibility. So clear financials and growth strategy. One of the things that we have noted is that there are some businesses where they don't consider financial planning important for your business. First, whether the handling or their financial records. There are some business owners where they see their management accounts once in 6 months, or their AFSs once a year. They don't care. That has got an impact on your business, because if you don't measure your monthly performance, it becomes difficult for you to plan, and where you need to do projections, you will not be in a position to do projections. So you need to have that clear. And also have a very clear growth strategy. Big business usually will have a 5-year strategy. What's making it difficult for a small business to have a 5-year strategy? In that way, if you were to sell today, anyone who wants to come into your business will understand that we are talking about someone who's serious here. And this is the value that we can actually pay for that. So those are some of the things that we're saying can drive the value of your business. So what has happened is that in the past, this system that we are using at MMCP, there were businesses that were analyzed, more than 70,000, whereby when you go in and do a quick desktop analysis, you would find that people will get a score of about 3.5. Let's say you were to sell, you sell at a multiple of 3.5. But after implementing those strategies to drive, the 8 strategies to drive your value of your business up, the score of your the score of your business goes high, meaning the marketability of your business goes high, meaning the EBITDA multiple that you can ask for your business actually goes high. So let me show you as an example how the impact of that. So what we have is a business with a value builder score, let's say of 77, has got pre-tax of 800,000, and they sell the business at 3.5 multiple. The value of the business would be 2.8. But once we go in and improve your score from 77 to 90, then even if you still get your pre-tax profit of 800,000, because you are selling at a multiple of 7.1, your business increases to 5.6 million, almost double what you would have initially gotten. So what you need to look at for you to drive those multiples, this is the solution to all those problems that I was showing you at the back, is the first thing that we look at financial performance of your business. And financial performance, we don't only look at your profitability on that. We look at the reliability of your financial records. Remember, initially I spoke about due diligence. As a valuer, when I come in, I want to see the figures. So if you don't have reliable figures, it's going to be difficult for me to do evaluation of your business. In that way, I'm going to discount your business because you don't have proper financial figures. Or you have been using your business to fund yourself. So I'm going to take that out to say, this is not business expenses, or the revenue is not sustainable. So financial performance of your business is important. So based on the key factors that are raised by a funder as well as the investor, if you want to do a match as to which one does this solve, you can solve the revenue model, or you can solve the profitability, cash flow, and that. So by just looking at financial performance, we can actually improve 5 things in your business. The next one is growth potential. On growth potential, we focus on revenue. And revenue, whether your revenue is sustainable or is recurring, or it's once off. And we're saying that a business that has got like retainer revenue is much more valuable than a business with once-off revenue, because where there is predictability, we are in a position to determine value. That where there is repeated revenue, that impacts the cash flows of your business. I spoke about that earlier. The next thing that we look at here, we call it the Switzerland structure. But what does the Switzerland structure deal with? It's the dependency of your business on one key person in your business, on one key customer, or on one supplier. So here we try to help you how to actually diversify your business, or how to deal with issues where you have got one key person or one key supplier or one key customer. The next one is your valuation teeter-totter. It's here we look at whether your business sucks cash or you can actually get some more cash flows in your business. So this looks at how are you selling on credit, or how can you quickly get income into your business. There are models that we would suggest. Let's say for a nail business, someone who's doing nails, usually ladies would go and do nails, you pay afterwards. If you want to increase the cash flows of your business, you do a subscription model for nails. You say to a lady, we are going to debit your account every month for 700 rands to come and do nails anytime. So whenever they need to do their nails, they phone and make an appointment. So that as well, it's one of the revenue models that you can use to increase cash in your business. The next one is recurring revenue. I spoke about recurring revenue. Let me go back to the growth potential. On growth potential, one of the other things that we look at is your niche market or your audience. It's important that you have got an audience. Let me give you an example of, we all know, is it Amazon or what is the other one? Alibaba, Amazon and Alibaba. Initially, they were called a distributor, distribution company, and they were valued as distributors. But we all know that they have diversified their businesses. Where I think it's Amazon, I think it's Amazon that has got now a movie section. And so now they have moved from being just a distribution company to an e-commerce business or an IT kind of a company because of how it's diversified. The other thing is let's look at where there is a different market, hospitals. Imagine Life Hospital. You know, Life Hospitals has got more than 300 hospitals. Life or the blue one, or Netcare, has got more than 300 hospitals, and each one in different areas. If I were to value the entire Netcare hospital, you'd find that there is one specific hospital that is bringing more revenue more than the other one because of the market that they are in. And there's growth potential in that market. So what we would normally do as valuers, we would value each hospital on its own and do what we call a sum of all or sum of the parts method of valuation, where we have valued all of those businesses and we put them together. In that way, you might find that one hospital could be worth more than the combined group of hospitals. And that's what is also happening with the likes of Amazon. My understanding is that one of their businesses is actually more valued more than the entire part of the business as it was initially structured. So you need to indicate the growth potential in your business, and we can help you to do that. The other one is monopoly control. Let's take someone who's the same guy that's doing potatoes. He's quite big in Limpopo, past Limpopo. He's quite big. So everyone, when you walk around and you call his name, people will say, oh, no, I know, because he's monopolized that area in terms of planting potatoes. So you as well, you can choose a market that you want to monopolize. Either it's through, let's say, it's different demographics, or geographically, you can actually decide to do that. The next one is on customer satisfaction. Here we look at what we call the Net Promoter Score. We all know that customers can make you or they can break you. So we assist businesses to calculate their net promoter score so that you understand where you want to improve your services. So that's that. The last one that we look at is the hub and spoke. In one of the sessions that I spoke about, I think it's the very first webinar, we spoke about the hub and spoke. Business owners can be bottlenecks in their businesses. If you are the main person in your business, you are the hub of your business, your business can be stifled for growth. So here we're saying run a business in such a way that you can be absent from it for almost 3 months. And how do you do that? We assist you with strategies on how to actually move away from being the hub of the business and allow the business to grow and have succession planning, have processes that you put in place to make sure that your business will operate in your absence. So if you are interested in us assisting your business to improve on the optics or the first impression that either a funder or an investor will get to see in your business, you are most welcome that you do what we call a value builder score. And that score will give you a gauge of where your business is. And where the gauge is less than about 59 or so, we know that your business needs some work. And it's not often that as business owners, we do a test of how we are doing in our business. So what we are using here, the Value Builder Score, it allows you to understand what can impact your business or what are the silent killers in your business so that you can deal with them. And for those that would like to do the Value Builder Score, you are most welcome to, we are going to post this on YouTube, but you are most welcome to go onto our web page, and there is a section where it will allow you to do the score. Alternatively, I think I will put that on the chat here, and you can just go and do your value builder, your score. And if you're keen on talking to me, we can engage on that. I'm going to allow 1 or 2 questions. I'm not sure if Joy, I'm in a position to allow questions. If there's anyone who's got a question, you are most welcome to raise your hand. Ooh, I'll allow mics for anyone who wants to ask a question. We still have 5 minutes to close our session. Okay, thanks, Joy. Anyone with a question? Hi, William. Let me see if I can unmute you. Yes, you can unmute yourself and talk, William. Thank you. I'm reading the chat. He says they want to thank you for the session. Yeah, Yes, we will send you the recordings. Everyone who has been with us today, we will send you the recordings. Makawe, thank you so much for joining us this afternoon. So anyone who wants the recording, we will email it to you. And if we will also email you the link to the Value Builder Score, and you can do the Value Builder Score. And if you're interested in getting the results, well, you can. I will contact you after you've concluded that, and we can take it forward from there. So thank you very much for joining us this afternoon. And we're looking forward to having you again in the next session. Don't forget, our webinars are the last Wednesday of the month from 2 o'clock to 3 o'clock. And we still have four or five more sessions that we are going to do before the end of the year. Thank you very much and have a good afternoon. Cheers.